T&M van lines, and we're very happy to support the economic presentation. For over 25 years, we've been providing furniture installation and office moving solutions through the Mid-Atlantic, specifically Philadelphia. We are both union companies, and we offer seamless coordination of all your installation and relocation projects. Both companies live together in the same building. It's a 100,000 square foot building in Morristown, New Jersey. And with that, I'd like to thank Kayla and IFMA for letting us introduce our company and enjoy the presentation.
You turn my phone off.
Thanks, Bob.
Thank you so much. Okay, with that, I'm going to introduce our keynote speakers for today's session. We have Dave Heckler from Watchdog and Jim Mullarkey with Newmark. Guys, now they are together in the same room. We thought it'd be a little more add to the dynamics if they were together. So thank you so much, gentlemen, for agreeing to that and agreeing to COVID restrictions with social distancing and masks. So I'm going to turn it over to you guys to introduce yourselves and take it away.
Hi, thanks for having us here. I'm Jim Mullarkey. I'm a commercial real estate broker with Newmark, Knight Frank, and a reformed attorney. I went to law school right down the street here at Temple and worked for Fox Rothschild as an attorney for a couple of years, and then went over in-house to the Rubenstein company and did all their leasing and acquisitions and sales. And while I was there working 80 hours a week, we had a brokerage group, and I saw the brokers working much less than 80 hours a week, making more money than I was and having a lot more fun. So I transitioned over to the brokerage group. At the time, Rubenstein was the largest commercial landlord in Philadelphia. So we leased 1 and 2 Logan, 10 Penn, 2000 Market. We owned Radnor Corporate Center, Radnor Financial Center, Plymouth Meeting Executive Campus, and then did the Valley Creek development. So great times, but then Rubenstein sold a big portion of Brandywine and Commercial Office Property Trust. So then I went over to Smith Mack and became a partner over there. I see Bill Finnegan on here. We used to work together at Smith Mack. He's transitioned into the mortgage business. And then Smith Mack, we affiliated with Newmark, and then Newmark ultimately ended up buying us. So been in the real estate game for, wow, God, I'm getting old, about 30 years, and still having fun.
Great. I'm Dave Heckler. I'm a principal at Watchdog. I started my career in Philadelphia at Arthur Andersen. Some people may remember Arthur Andersen. Some people probably don't even know who they are at this point. After Andersen, I went over to Equus Corporation. I don't know if you remember Equus Corporation, an international brokerage firm, which is now basically Cushman. They were Equus, UGL, and then DTZ, and now Cushman. While I was there, I was doing project management. So I was in a brokerage firm offering project management services. In 2003, I was looking for something different, and I founded Watchdog. Back then, we hit the market at a pretty cool time. There hadn't been a new high-rise in Center City, Philadelphia in 20 years or so. And there was this new building everybody was talking about called Cira Center. And we were lucky enough to win a bunch of work in Cira Center, and it really helped get our name out there. So since then, we do corporate work, we do institutional work, and we are probably the largest third-party project management firm in the Philadelphia area.
They like super chill. I was like, do I have to do this during the week or can I do it on the weekends? Like, whatever.
Somebody's on, not on mute.
No, I thought everyone was muted, but yeah, if you guys could make sure that you do stay muted. Okay, so some of the things we want to talk about this morning with you guys, real estate forecasting for 2021, not so much economic. Of course, obviously economics plays a part into this, but some of the things that you have been seeing and trends from 2020 and going into 2021 based on companies that are all switching over to working from home, which, you know, the majority of us on here today are working from home.
Yeah, so I'll handle that one, Christine. Yeah, it's kind of hard to forecast anything with the pandemic kind of blowing up 2020, but we did some polls, and pre-pandemic, up to 12% of people were working from home or doing some sort of hybrid. And right now, and actually this number sounds low to me, we're saying 35% of employees are working from home. And who knows what's going to happen with the post-pandemic, but we're tracking occupancy, and that's physical occupancy in offices downtown. And really they're empty. I mean, it's under 10%. Comcast is on record as saying they're not going to go back unless the vaccinations change back to the two towers till July 1. So it's just going to be a question of how many people come back into the office. As far as the overall market, people aren't shedding space and they're tied into leases, but an interesting stat is, I guess our vacancy rate, people shedded in the overall Philadelphia market about 685,000 square feet for fourth quarter of 2020. And that's the largest quarterly loss since 2009. And the breakout is CBD shed much more space, 550,000 square feet, and the Philadelphia suburbs were about 136,000 feet. And that's office. Industrial markets are holding up. There's only about, and our overall vacancy for the general Philadelphia area is 15.1% in office. Flip that to industrial, it's only 5%. Industrial is just cruising along. Rents are getting pushed up. The leasing volume was up from fourth quarter of 20 to fourth quarter of 19, 12% last year. So the last mile and all that stuff is doing real well. Dave?
I'll just add I heard an interesting stat, and I don't know how accurate it is, that the average Center City Philadelphia high rise pre-COVID had 2,000 to 3,000 people go through it per day, and now it's 1 to 300.
Yep.
So that kind of shows the big difference there. And the question I think everybody wants to know is, when are people coming back to work? And Jim and I talked about this before, but what we've seen when COVID first hit in March, we saw all of our clients talking about, oh, we'll be back in the next 3-4 weeks. Then 3-4 weeks came around and, May, June. Then May, June came around and that pushed out to sometime in the fall. So the timeline keeps getting pushed out, and people are more comfortable with pushing that timeline out now than they were back in March. So now we hear a lot of people saying June, July of this year. I mean, we even have a few people who are saying September, October. And I really believe that everybody at this point, and what our clients are telling us, is it's really vaccine dependent. So, how fast is the vaccine going to be rolled out to people other than frontline workers? So the whole work from home thing, I think, is still fluid. I don't think people have really drawn a line in the sand, and the ones that have are still willing to push it out because most people have been able to accommodate working from home. So I think that's still a TBD for us on when people get back in the office.
And I just to add, I think especially publicly held companies are very sensitive to the liability issues of COVID to force somebody back to work. So I think it's going to play hand in hand, as Dave said, with the vaccination. And I think some people are, myself included, itching to get back in the office, and others really, found another hour in their day or 2 hours in their day to commute, and they don't want to come back at all. And I think the driver is going to be how productivity. I mean, people are going to be able to measure productivity, and does the productivity fall off if people at home? Does it increase? So remains to be seen.
So I'm actually going to launch the first poll question. Hopefully you guys can see it. Your comfort level, return to work. And this is completely anonymous. And it's multiple choice. Which of the, below kind of describes your team's feeling?
Oh, that's pretty cool. I want to guess that. Cautious but optimistic. This is like watching a horse race.
All right.
I'll have to go back through because we've had questions like this on these in the past and see how this has changed over a 6-month period.
Yeah, that'd be very interesting.
It would be interesting, yeah.
All right, I'm going to shut this one. I'm going to close this one down, but it looks like the winner is cautious but optimistic.
Yeah.
So
I think that sounds about right.
yeah, cautious but optimistic, followed by excited and prepared to return, and then concerned about safety in the workplace. And that, that's probably for a bunch of different reasons.
There's a new topic to be debated when we talk about going back to the workplace, and that is vaccination going to be required or not? And it's a hot button out there right now on how different organizations are going to deal with that, and a fairly new one. So that's going to be real interesting to see, what happens as far as requiring people to have vaccinations or not.
Yeah, I guess, and Dave weigh in on this, but it seems most companies are kind of on a split schedule. If they're bringing people back in the office, and one group will come in Monday, Wednesday, Friday, and the other Tuesday, Thursday. I know every day we poll, unfortunately it's rapid emails at Newmark. Do you plan on coming in the office? Have you, 4 questions, but it's more like spam, but you reply that you don't have any symptoms, and they kind of poll that. And then, everybody's social distancing in the office, but I would say, it's kind of still a ghost town. We had just moved our company from 1735 Market to Commerce Square. And whenever I'm in, there might be 1 or 2 people in there, but that's kind of what we're doing. And I think that's kind of the trend.
I think it is indicative of the trend. Yeah. I mean, the when we first got into COVID, everybody was talking about how to get everybody back to the office. And I think that has transitioned now to how do we get certain people into the office, or how do we have staggered schedules, or this group comes in 3 days a week and this group will come in 2 days and overlapping them. So the thinking now versus March of last year, almost 10, 11 months ago, is very different. And the approach is very different too. So, and I think that'll continue to morph as we get into this a little bit further.
Well, and I think you bring up a good point with considerations for these larger buildings, and the vertical, as far as people getting to their office space. So this brings us up to our second poll with what considerations have been made regarding the elevator and stairwell needs in the socially distant environment, staggered entry times, reduced capacity, improving your stairwell options. What have you guys been talking about with your staff and with your offices?
Well, elevators, I would, all the multi-tenant buildings downtown, I think no more, a couple of them are 5 with, feet placed dots on there. Some are 4, but they really haven't had to deal with it because, as Dave said, I mean, the occupancies are down there. So, there's talk when we get back full time. I know some buildings are asking people to come in and stagger it at different times. If you have the luxury of having multiple exit and entrances points, they're going to ask people in different parts of the tower to use different entrances and exits. So I know Brandywine has closed a bunch of entrances, and they just kind of funnel people to an entrance and an exit. But yeah, as more people come back, you're going to have to start putting those things into place, but the occupancy's not there yet.
I mean, that's the biggest downside to Center City right now, is dealing with the vertical circulation in buildings. And destination control is one thing a lot of people are talking about. Reservations for your elevator, which I don't know how that one works, but it's another one that people have talked about. And one of the things we saw initially too, back in April and May, was people talking about how bathroom design would change. So that you're not running into people in the bathroom, and it would become more of a airport style bathroom with an in and a separate out, and you kind of do a U to get through it. We haven't really seen any of that. But I think that's one of the initial, hot items that everybody was talking about that kind of fell by the wayside as we got more into this.
And some of the other things too we're seeing with a lot of companies is workplace redesign, where, open floor plans were a huge push in the last couple of years. Now, all of a sudden, nobody wants to be in anybody else's space.
Yeah. Yeah. And that's another one too, where we've seen all these, when this first started, people were willing to make drastic changes or talk about making drastic changes. UV and the HVAC and, doing all of this stuff to the workspace. And as time has passed, the intensity or the drasticness of what they're willing to do has decreased a little bit. We're seeing a lot of common things, every other desk, but people aren't necessarily willing to redo all their furniture. They're just making you sit every other desk. Some plastic barriers coming up. So the intensity to which people are willing to make the changes has decreased a little bit too. And we'll see if that holds water.
And it all comes at a cost too, right? So you have to do the cost benefit analysis. And I think people are just kind of, I guess they're hoping that the vaccination, rolls out, and I guess the herd immunity, and they're not going to have to make wholesale drastic changes. But again, it's TBD.
The survey kind of shows us there. We're changing some areas to reduce density. I mean, I think that's what we're commonly seeing is just that density factor. And whether that's changing a workspace to achieve that less density or going to a hybrid schedule with people, I think that's really the one people are focused on. Let's bring 80% of the workforce in for 3 days, and there's an overlap. So they're reducing the density by reducing the number of people allowed in an office on a daily basis.
Yeah, and I know with a lot of our audience here with IFMA, a lot of our members, a lot of this falls to the facility managers.
Yeah.
So that's a big concern with some of them with what do we do and how do we do it? Have both of you started to see people exiting Center City or moving from from these areas into kind of out into the suburbs more, or into smaller single tenant buildings?
We haven't seen a lot of that. I guess there was a small law firm, maybe 2,000-3,000 square feet, that I guess the partners all lived out on the main line, and they were downtown, and they're just like, hey, this is a good opportunity. Their lease was coming up. Let's move to Valley Kinwood or somewhere else so we can cut our commute down, not have to pay for parking. But there hasn't been wholesale. I think what we've seen too, if you've had multiple offices in, say, downtown as a satellite, or suburban satellite, people are taking the opportunity to kind of close those satellite offices, both in Philly or even in the suburbs, and kind of consolidate. But there hasn't been any drastic people announcing like, hey, we're pulling out of the city.
Yeah, out of the city.
And
I think it's going to be a little while till we really know the ramifications of that, because all we have right now is data from the people whose leases happen to be up right now. I haven't seen anybody say, oh, I got 7 years left, I don't care, I'm out of the city and in the suburbs. I haven't seen any of that. So I think over the next 3 to 5 years is when we really see that, as people's leases roll over and they're making conscious decisions of, hey, you know what, that was a real tough situation in Center City with COVID. Let's go to a low rise in the suburbs so we don't have to deal with that. That data, I think, is really yet to come.
And I guess, 2 deals to note that were just recently inked. Blank Rome, who's at One Logan. And, the press is out there saying that they had the utmost flexibility. And the way I think the Business Journal article made it seem was that Blank Rome could, go from 200,000 square feet to 1,000 square feet. Well, that's not the case. And pre-COVID, they were out on the market for, I think, 100. They were in the 100 to 125,000 square foot range. And they just did one of the few long-term leases that are being done, 16 years. And they do have the flexibility to downsize from 200, but the floor is 100,000 square feet. And they made the commitment, and their space, they're going to be gutting their space and really redesigning that. But I think most of that was pre-COVID anyway.
Yeah.
And then Baker Hostetler just announced the lease. They're going to 1735 Market from Sears Center, and they're in about 80,000 feet now, and they're going to 44,000. But that's not really COVID related, because it used to be Woodcock Washburn. They were bought by the bigger firms, so they had all their back offices at Sears Center. So forget about COVID, they were going to be in that 44,000 range anyway. So you can't really say COVID caused them to
Yeah.
drop half their space. That's just not.
I think that poll tells a lot right there. I mean, if your lease is up to renew in the next 24 months, are you planning to change the term length? And renew as is, 70%. I mean, kind of tells you what we're up against.
Yeah, I think, for any of my clients that are coming up, I mean, I'd have a hard time unless we needed to rip everything up, not doing an as is renewal, as is where is renewal for a short period of time, maybe a year, 2 years. And that the landlords are being flexible and working with tenants on that. And when COVID first came out, I guess a lot of tenants were like, hey, the city's closed. Why am I paying rent? And you'd have to caution them because you have a lease and technically you can get into the buildings and the landlords aren't going to forgive rent. So, at first March, April, a lot of real estate brokers were busy trying to talk to landlords to see what could happen. And the first, knee-jerk reaction is, why am I paying rent? But I counsel all my clients to pay rent because if you don't, you're going to be in a breach of lease, and that's going to be a bigger issue. Now, there have been tenants and landlords have worked with tenants, but a lot of people were looking for a lot of free rent and not to pay the rent. Most landlords would say, you need to demonstrate to me your financial need. And so give me your financials. Did you apply for a PPP loan? Is it really hurting you? And, if you could prove that, landlords would, they're not really in the business to give free rent, but they would do rent deferments. So they would just say, okay, pay half rent, or you don't have to pay any rent for the next 6 months, but come
Hit you on the backside.
Yeah, and either spread that out, like say in 2021 or end of 22, you'll start paying that back, some with interest, some without interest. And landlords were looking to extend the lease to do that. So most landlords would work. I would say, look, the restaurant retail business is a different story. Those guys are closed. The money's not coming in the door. They're not. I represent a couple restaurants. They just can't afford to pay rent. So landlords on the retail end have been working with tenants to either do some sort of forgiveness. We've seen some percentage rent, but hey, if the doors are closed like they were in a lot of places, you're not paying rent, but the landlords have to pay the mortgage. So it's kind of you have to balance it out. And landlords don't. I've had people that are, Kent in New York and in Philly too, that if the landlords are going to push them, they're just going to throw the keys back and there'll be litigation. But for the most part, I think landlords are, if you can prove it, they'll be willing to help. But in a rental deferment, not a rental abatement.
And the stats show that tenants are still paying rents, right?
Yeah. Oh, the office and apartments too. It's in the high 90s. Again, retail being separate.
Retail.
But if you're making money from home, the landlord's going to expect you to pay rent. But if it keeps going on and on, I think that's going to be a different story.
Yeah.
And that's what it looks like the trends are with our group here. Most of them, the negotiations have not changed.
I think people are looking for deals right now, or hoping for deals right now. And the problem is the deals I don't think are there, and correct me if I'm wrong, because people are paying, number one, and number two, we haven't seen that slew of space come on the market yet.
Yeah, landlords, I think, going back to 08, 09 and the financial crisis, landlords are in better shape this time around, I think. So they are not, they're not discounting rents. There's downward pressure on rents right now, and everybody, especially I have a client in New York that's has a lease in Philadelphia, and he's like, I want a 40% discount. Well, it's just not there. It might be in New York, but when you were paying $100 a square foot in New York, maybe the landlord can eat that, but it's Philly's kind of, and the suburbs, it's a tight market, and the discounts aren't going to be there. Where you are seeing landlords much more flexible in term, they will, concessions have gone up. So, and by concessions, I mean free rent for a new lease. that's gone up, and TI packages have gone up as well. So rents, if some landlords start discounting rents, then I think you're going to see others follow suit. But there's not that many, the deals aren't there yet. Where you can get a good deal is the sublease market is up to about 2.7 million square feet. Now, reversed from the suburbs and the city, there's about 1 million square feet of sublease on the market in the city and 1.7 in the suburbs. So, so people are, and I think you're going to see more sublease space coming available. Some people are listing it and saying, hey, if I can sublease it and get rid of some of my space or a satellite office, let's do it. And others, are saying that they're waiting, I guess. So I think you're gonna start seeing sublease tick up even more. But
I think that's the leading indicator for us to watch, is the saturation rate of the sublease space. Because if that space keeps coming on and it's not being absorbed back into the market, that's telling us that the people don't need the space anymore. If it's getting absorbed back into the market, then maybe there's a glimmer of hope there. So that saturation rate, I think, is really going to be critical.
it is critical, and you are seeing some people take subtenants too. If they want the flexibility, it's already built out. They don't want to come out of pocket, and they're willing to, if the space is in good condition. I think a really good example of this is the co-working space. Make Offices just announced on the 14th of January that they're closing their 3 locations in Philly. They're at the Bourse, 2 Commerce Square, and 1635 Market, about 135,000 square feet. Now, JLL has already taken over their DC offices. So this is a cheap, so like a JLL or a Newmark or somebody else, the space is all built out. They can basically buy into the co-working cheap. So I think either JLL or somebody else is going to backfill those offices, and we represent WeWork, and WeWork allegedly is going to be profitable in 2021 at the end, but they have 5 locations in Philadelphia. We just are working on a termination of 1430 Walnut, which is 17,000 feet, but the other 4 locations WeWork is bullish on, and they didn't really need 1430. And I think somebody else in the co-working business is just going to take over that lease, and the landlord will be fine. Landlord would probably break even or maybe even make some money on it.
Yeah.
Can you talk to the difference between the industrial markets and commercial markets, what you're seeing?
Yeah, industrial's red hot. It's all the last mile, with all the online shopping, and it's just, it's flying off the market. I represent a national tenant, or nationally known, and we just grew out of our space, and we had to dig up a deal off market. We're going to go from about 51,000 feet to 116,000 feet, but it was an empty industrial building that had been vacant, needs a lot of work, and we had to pay top dollar for it. But on the flip side, the buildings we're selling, which we'll lease for a little bit while we're building out the other one. I mean, it was basically, it was like we had multiple offers. So, the industrial market's just red hot right now, and there's not, if you're in a good location. And commercial, look, there are a bunch of downtown office towers that were on the market. They've all been pulled due to COVID, so nothing's really trading. Suburban starting to see some office, but I think, the landlords are going to just wait it out until this all shakes out. Owners aren't going to sell cheap yet. So there's just not, there's kind of a pause on the capital side right now.
I think it's going to be interesting to see how malls, retail and shopping malls, the adaptive reuse of those and how that mixes in with last mile facilities or industrial in general, and distribution facilities. Because you see a lot of people looking at them right now as options, and whether that really ever takes off or not, it'll be real interesting to see.
Yeah, Preet's a great example of that.
Yeah.
I think they just, the Morristown Mall in New Jersey, they're going to try to do apartments and commercial and maybe some sort of flex. So
Yeah.
That would be one to keep an eye out, because look, retail bricks and mortar has been decimated right now. So, so you'll see some reuse on that. Another thing to note that's interesting with Philadelphia, I mean, we've always been known for eds and meds, but life sciences is booming. And, University City lab, you can't get lab space. So what that has had owners looking at, downtown, 2301 Chestnut's looking at a lab conversion. Wanamaker, who just Chop's going to probably downsize 220,000 square feet. And then the Department of Labor is moving out 135,000 and downsizing a bit into 1650. So they have 300,000, and they are going through the analysis of what that would look like with a conversion to lab for a certain portion of that building. And Sierra Center that Dave mentioned, they're looking at converting six floors of the original Sierra building, the lower floors, to lab. And I think they have great traction. Now, the issue with the lab conversions, and you can speak to this, is it is a ginormous amount of capital to convert. But if you can get a $50, $60 triple net rental rate, it pays off.
It's the infrastructure requirements. Do the buildings have the ability to add the additional infrastructure from an air electric standpoint? But there's a race for it right now. BRT is doing that at Sierra. They're doing it. I think they're doing it at Comcast or FMC too. They're looking at making.
Yep, they're taking a look at that, and older buildings, which I don't know, like Wanamaker is a 100-year-old building.
Sometimes it's easier.
Yeah,
you have bigger shafts and stuff.
And you have the infrastructure in there, and those were department stores. Who else is the 3 Parkway has a big office vacancy that they're looking at converting, and so that would help the office market. I think we're tracking that in the downtown area in University City. There's potentially a total of 2.2 million square feet being converted to labs. So if that happens, that's going to drive the vacancy down, and more people and attract more companies to the city. So that could be a potentially really good sign.
I think there's going to be a lot of change in the coming years as far as how we currently use buildings and what are they going to be used for. There's a race for lab space right now. If you look at hospitality, there's going to be big changes in hospitality. Right now, you have a lot of privately owned hotels that probably aren't doing well or are about to go under. And we see a lot of people looking at those and looking to convert them to apartments, coming in, buying them up.
Embassy Suites with Pearl Properties just announced that they're converting the Embassy Suites right on the Parkway to apartments.
Yep.
So I think, and hotels, I don't really work in the hotel space, but it just sounds like those guys they're getting decimated too.
We've had some developers come to us and look at hotels. And what they're saying to us is, okay, if I buy this piece of land over here, it's going to take me 2-3 years to develop it and X amount of dollars. And I have the risk of not knowing what the market is going to be like, 3 years from now. Well, I have this hotel over here. I could buy it. The asset sits there. And if I can carry the cost for 2-3 years, is it more than I would have spent developing this piece of land? And a lot of times when we do the analysis, the answer is no. And they're saying, I'm just going to buy that hotel, sit on it till everything turns, and then I have a functioning asset like that. So developers are even looking at different ways how they're going to implement their money into the marketplace.
There will be opportunities. And I think another example, just what COVID had done, the Hahnemann portfolio, there hasn't been a whole lot of traction. I think, we have a portion of it for sale in JLL, and we just announced that we would break up the portfolio, and where initially it was thought that, somebody would buy maybe the whole portfolio, but I think now it's going to get one-offed, and, and that's a victim of COVID too, and all the uncertainty, because, pre-COVID, they thought this is a once in a generation opportunity to develop such a big portion of square footage, right in Center City, but the market hasn't, stay tuned, it hasn't materialized yet.
Yeah.
All right, I'm going to switch gears on you guys for a second, and I'm going to ask the audience. So outside of return to the workplace effort, What are some of your main priorities and focuses in 2021? Those of you that are involved with facility management and real estate. I think we have a lot of knowledge in this room, in the room over there with Watchdog, and want to get their opinions.
Don't be shy.
I think we have a lot of salespeople on this.
Possibly, yeah.
Oh, I
Is it
saw
five
one of your questions, Christine, was on subleasing, and I think the vast
Yes.
majority was that. Well, can you pull that one up again? That people
Sure.
weren't considering subleasing.
Yeah,
Yeah,
it's good.
Yeah.
that's this one. Let me pull up the other. The sublease. All right, subleasing.
I think the moral
So
of the
that-
story is we're seeing everybody just agreeing to sit and wait, sit and wait. You
Well,
know,
I think
no
with the
one wants to trigger.
vaccinations coming out, and I think we'll hopefully see. I thought J&J was close to doing it, but they must have got some setbacks. But you know, that's going to ramp up. And
Listen, the bad news is for this year, there's not going to be as much work out there. The good news is there's a lot of pent up demand in 22, 23. I mean, all of it has to let loose at some point. And people sitting still and not doing anything just kicks the can down the road.
And I have one client that, right at COVID, they're like, okay, we're going to shed 50% of our office space. But I think now we're going to delay a little bit. And I think that percentage is going to go up. They will downsize somewhat, but it's not being employee driven. It's just, getting more efficient. And then I think they thought that everybody they'd be able to work from home, and that's the way it was going to be. But I think they're rethinking it. So I think as time goes by, you're not going to see people shedding 50% of their space or 70% of their space or closing, the bricks and mortars down to work from home. But
I think that was a big question everybody had. How much space is going to come on the market? People aren't going to use the office anymore. This is going to affect the corporate market industry drastically. And I think at the end of the day, what my gut tells me and what I'm seeing is it's going to be a wash. There's going to be puts and calls on both sides of it. A company that, maybe they're only going to bring 80% of their workforce back over a staggered model, but they need to spread people out a little bit. So it's not like they can get rid of 20% of their space. They're still going to need the space they have to spread their people out. They're just bringing less people into that space. So I think the net effect is going to be kind of neutral. I don't think we're going to see people taking additional space to spread people out, but I don't think we're going to see people taking or giving back a lot of space. But time will tell. I mean, I really think that's a 3 to 5 year not decision, but it'll be 3 to 5 years till we really understand that.
yeah, and I know, companies are polling people, and this is a smaller company owned by principals, and they polled all their workforce and to see how they liked working from home, and they all said, we love it, let's continue to do that. And they're like, great, well, we're going to shed 25 or 30%, we'll just hotel the desks. They're like, oh, no, we still want our own space to be able to come into our space with the kids' photos and all my work there. So they wanted to work home 4 or 5, 5 of the days, but when they did come in the office, they still wanted their individual spaces.
Yeah, it sounds about right.
How do you see Philadelphia comparing to other regions or other geographies that you're in contact with? I mean, we're Northeast, but compared to anything you're seeing with the South or on the West Coast, or just overall, other geographies?
I'll speak to West Coast. What we see in Philadelphia versus what we see in LA is very different. So we have several clients in LA who have just pulled the plug on their businesses totally and are saying, I'm out of here. And there's this migration to Texas. Austin,
San
in and around
Antonio,
Austin
Dallas,
area. Because LA has so many challenges now, and they had challenges before COVID, but with COVID, it's just compounded. So we have seen out there several clients just say, see ya, I'm not gonna do this anymore. I haven't seen that here.
No, Philly hasn't, the thing I always say about Philly, we don't have the peaks, but we don't have the troughs either, so.
Little train it could.
Yep, New York, I think we're seeing New York is a lot of people moving out residential. I live downtown, and I don't see people leaving en masse, but New York's a different story. And one of our guys in New York that does a lot of financial services, he basically set up shop in Florida because he's like, all my clients are moving to West Palm Beach, and the CEOs have houses down there, and they're opening offices up in Lauderdale and Palm Beach and Miami, and closing their New York offices. So I think you're going to see that trend. And with COVID, if you're in a 400 square foot apartment with 2 people, it's not, then you're stuck there. So people have been moving out, and a bunch of our employees that lived in the city in New York, they all rented houses out, in the suburbs, and they're riding COVID out through there. So
I think a lot of people have done that. It's going to be interesting to see how companies deal with it, though, because you do see companies now where people going to their organization saying, hey, I can work anywhere. I'm going to move to Bisquick, Idaho, or I'm going to move to, Tampa. And then how the companies deal with that as far as compensation and adjustments and things like that. It's going to be one of the challenges for 2021, I think.
Yeah, especially if you move to the other side of the country, you're not coming into the office to collaborate or do it.
Yeah.
And, so, I think echoing Dave's, I don't see this as going to be changing commercial real estate. It's not going to be, it's probably going to bounce back, and we're going to meet somewhere in the middle.
Yeah.
All right, we are rolling into, it's almost 12:50. I'm going to launch one final poll, which is just something that I know for commercial real estate, we're curious about how satisfied you are with the measures your landlords have taken with respect to COVID-19, 5 being highly satisfied. And again, this is completely anonymous.
And I see Bill Fagan asked a question on Hahnemann we talked about, and the Archdiocese has a big, right by the cathedral, the Basilica, they have a big office building and parcel of land, and that is on the market. And I think COVID just kind of, is putting that on hold, but they're looking at doing a really cool development of apartments, maybe condos, office buildings on that parcel, but it hasn't, the traction has not been there yet. And I think at some point it will, because it's such a great piece of land right in the middle of the parkway that you're going to see something get done there.
That's interesting. Somewhat satisfied. I would have expected that to be very satisfied. You would think landlords are going above and beyond.
Yeah, it's very satisfied at 29, somewhat satisfied at 41.
Yeah.
And look, I think landlords have taken some, for the most part, precautions, and are, implementing social distancing. But the $1 million question is, when the downtown office does get up to 50, 60, 70%, how's that going to work, and what's that going to look like?
Well, the other thing too is the changes they've made, are they sustainable? So a lot of the changes I've seen work right now, but like you said, I don't know that they're sustainable for the long haul when volume changes.
Well, and I think everybody's hoping that herd immunity does develop, and we don't have to take these measures, but you can only push it out for so long, though, before you have to start doing something if it doesn't materialize.
I want to open it up at this point. If anybody has any additional questions, if you'd like me to unmute you, so that you can, feel free to, vocalize a question. I know it's tough seeing all these little tiny boxes with people's faces. I do want to offer it. I can leave this open once we're done with the speakers, if anybody would like to chat or you know, we will get your Dave and Jim's contact information to you if anybody has any follow-up questions or emails that they'd like to ask them.
We must have done a good job. No one has a single question.
You did a great job. It was very informative. Thank you.
I do have a question.
Go ahead, Colleen, was that you?
Yeah. So what do you think if companies are putting space on the market in the next few months, what do you think the absorption rate's going to be timeline wise?
I think it's gonna take a while to do the absorption. And then out of all the sublease space, I guess I'm curious as to, you know, there are people saying, hey, I'm gonna throw it on the sublease market. If I get somebody, you know, great. But I think you're gonna see maybe companies say, well, I really need that space or I use it. So it's going to be a question of how much is true sublease versus shadow. And I do think, you know, you'll see some of the sublease space get taken just because with the economy, it'll be a better deal and it's built out. So that whole thing about the uncertainty, you might only have to do a year, 2 or 3 year sublease term. And, you know, you get the flexibility and you get the economics. So I do think some of the sublease space is going to go. Look, if your space is 10, 15 years old and you're trying to sublease that, I don't see why somebody would jump on that when they could. So I think the more attractive sublease space will get leased up. And when things get back to normal, I think people are going to do the longer term deals. I mean, it's all a function of the uncertainty right now. If you need, and this is why Blank Rome and Baker Hostetler had to do 16-year deals. If you're going to gut your space and have Dave build it, that's going to be, you know, $150, $200 a square foot. And the only way the landlord is going to give you TI money, real TI money, is to go on a longer term lease. And assuming the landlord's capitalized, which I think they are. But, you know, Blank Rome and Baker Hostetler for those 16-year deals got in the range of $90 a square foot of TI. So it covers it a long way. And there was a nice free rent period too. So
Yeah. That's a nice tenant TI dollars.
Yes. Yep.
What exactly is TI money? I've heard
Tenant
it as a
improvement.
second or third,
Yeah.
Tenant
So,
improvement dollars.
yeah, tenant
Okay.
improvement to
just for the audience.
Yep. Free rent is you get a period of free rent on a 15, 16-year deal. You're probably getting, 10 months to 12 months of the initial term free. So the tenant can kind of fund their build out with the tenant improvement dollar allowance and with the free rent. So, but yeah, the landlord, if you only want to do a 2-year deal or a 3-year deal, you're not going to get you're going to be coming out of pocket a whole lot if you want to build out space. And then why would you do a 3-year deal if you're going to put that much money into it? So that's where I see the subleasing, if it's in good shape and it fits the potential subtenant, then I think it's a good way to go today.
What did you say? How many square feet did you say is on the sublease market right now?
2.7 million, 1.7 in the suburbs and 1 million downtown. And you've had more downtown has shed, so people like Blank Rome renewing in less space. So that's about 550,000 in the city of vacant space that the landlord now has and is trying to market and tenant versus the suburbs, which was only 135,000 square feet of sublease. And we expect that sublease number is going to climb in
Right.
21 first, second quarter.
And then one last question so if there's 1 million in the city, how much of it is tenant sublease space versus landlord marketing space?
So the landlord is 500,000 square feet and the sublease is 1 million. So it's a total of 1.5 million. And then the sublease in the suburbs is 2.7 and then about 135 direct. So now.
Can you say the city again? I'm sorry.
Yeah, it's direct space is 500,000.
Okay.
And sublease space is 1 million.
Oh, okay.
So now there's a hybrid in there too, because any landlord, if the tenant's trying to sublease it and the landlord would probably rip that lease up and do a longer term deal. So
Right.
most, if not all landlords are working with the tenants and the brokers to say, yeah, if you want some more TI dollars, well, the tenant
Sign
can
a
pay.
longer.
Yeah, the tenant can
Yeah.
pay a termination fee, or they'll give the subtenant a better deal and they'll underwrite that. And then the landlord would, tack on term or some form of that. So I think that'll go a long way in, clearing up the sublease vacancy too.
Yeah, so if we had 2 years left and we get the landlord involved and he can get them to sign on for another 8, the tenant's going to win in that deal because the landlord's going to give them more TI
Exactly.
and free rent.
Now,
Yeah.
the landlord might say, I'll let you out of the lease, tenant, pay me something, but if you have that
Offset
lease,
his costs.
yeah, if you have the lease to backfill it, whereas landlords, probably common sense wise, if I'm going to a landlord and saying, oh, my tenant wants to get back space, are you gonna let them walk? The answer is no.
Yeah.
But if there's a
Thank
lease
you.
backfilling it, then the landlord would be happy to talk to the tenant about ripping the lease up.
Great.
Yeah,
Thank you.
I have a quick question, more operations. With the minimization of occupancy, are you seeing landlords doing much with their HVAC systems following the guidelines of CDC, ASHRAE, and others?
I'll jump on it with, the filters aren't a big cost. So most landlords are doing that and upgrading the filters. At the beginning, I think tenants were worried about air changes and all that. And I had a conversation with one landlord, and it's a 30-year-old building. He's like, there's only so much I could do. And hey, if you want me to rip out all my systems and put brand new systems in, your rent's going to go through the roof and your operating expenses. So that kind of satisfied the tenant, the filters.
I think most of what we've seen is our clients asking us to go to the landlord and seeing if they can make adjustments to the system that aren't capital improvements, meaning, can we get more outside air in? Can we have more purges or do 2 purges on a daily basis? It's more process and procedural than it is capital improvement. I think building owners probably initially looked at all the capital improvements and they quickly said, not right now. Maybe when life cycle analysis happens or life cycle comes up for them, they'll make those changes. But I think it's more operational than anything else as far as number of air purges per day, amount of outside air and things like that. And the ones that we've talked to, a lot of them are open to that.
Okay, that was my question. How much are they actually following the guidelines
Yeah,
for operations?
I can't say how much they are or aren't following guidelines. I can say that the ones that I know of that we've talked to are open to making changes that aren't capital improvements, that are more operational. And
I would say most are willing to do that.
Yeah.
If it doesn't cost them any money or very little money, they're going to do that to,
Electric.
it's to peace of mind for tenants, so I would say most, if not all. Brandywine's done a great job of putting a bunch of protocols in and doing the filters and air changes and all that stuff. Question for you guys, especially our sponsor, with furniture. I'm seeing a glut where tenants that are downsizing, they're dumping all this furniture on the market where maybe a couple years ago, you might be able to get some money for it, at least to cover the breakdown of it, but that doesn't seem like that's holding.
I unmuted you, Bob. Go ahead.
Okay. I say that was way before COVID hit, to be honest with you. Tied in with T&N van lines, we're constantly tearing furniture down and it goes to the dump. Rarely seeing people able to sell anything. So I would imagine now is almost impossible.
Yeah, But
what I wrote on there is we've been seeing some projects we've had, they're kind of nice projects where just deciding to get rid of all their furniture, maybe move it inside the same building to a smaller space and buy all brand new furniture, which is a good thing. You know, we don't like seeing people downsize, but you know, it's creating work and it's giving them a new space, and half their employees are at home anyway. Well, actually, way more than half. You know, you touched on that earlier.
Court wants you to rent furniture. And I know this is mostly a commercial real estate group, commercial facility management, but we had a question in the chat. Anything that you guys are seeing from residential high rise with people leaving? I know we talked about people leaving New York City, but how about from Center City, Philly out to the suburbs and rent prices dropping and more vacancy?
I got nothing on this.
Oh, since my daughter's looking to move to Philadelphia, we've been in the apartment market. She has a free place at my place, but she's like, I think I want my own. So for high rises, the rents kind of are still holding. They may be ticking downwards, but what we're seeing is just for like a 1-year lease, they're coming out of the gates with 2 months free out of a 12-month term, which, you know, it's a pretty nice incentive. But and there's a lot of you know, construction with condos and apartments, but condo prices have kind of held. Like residential real estate prices have held in the city. I think rent is you're going to see the rent go down a little bit, and you're going to see the concessions come in. But the selling bricks for condos and homes hasn't really had any effect. I still think it's a pretty hot and tight market.
All right, well, we are at 1 o'clock, so I do want to thank everybody. You know, I want to be respectful of Dave and Jim's time. But thank you very much, everyone. We will have the recording. This session was being recorded, and it will be out on the IFMA Philadelphia website. It'll be out there probably within, I would say, give us till Monday or Tuesday, and we'll get this out there. And you know, feel free, if you want to unmute yourselves, if you have anything you want to chat with anybody, feel free. I can leave this open for a little bit.
Thank you,
Otherwise,
Christine. This was very informative. I really appreciate it.
oh, thank you very much. I'm glad that, look, we had a great turnout. So I do hope that everybody benefited from it. And I really, really would like to thank Dave and Jim. I mean, it was just great having you guys, the dynamics of having you guys knowing both sides of this was great.
Thank you.
Pleasure.
Thank you.
All right, we'll hope to see everybody again and at our next event, which is on February 4th. We have a webinar, I think it's risk mitigation, Kayla, is that what that one is?
Managing risks.
Managing risks.
Yep.
All right, ifmaphilly.org if you need to go sign up.
Thanks, everybody, for coming out. Appreciate it.
Thank you.
Thank you.
Thanks, everyone.
Bye-bye.
Thanks, Jim. Thanks, David.
Thanks.
Our pleasure.
Court.
Dave and Jim, thanks a lot. It was a great session, guys.
Thanks.
Thank
Yeah,
you.
thank you guys so much.
Yeah, thank you, Steve, for coordinating this.
Yes.
It was a great day. Thanks, Christine. Great job moderating it. Had a nice turnout.
Yeah.
And I learned
Christine,
a
thanks
lot
for
doing the
everything.
polls. That was fun. I've never done those
Yeah.
before.
That was really sharp. Now, is that an app that you were using, Christine, while you're doing that?
It's part of Zoom. It's actually
so
a
it is
feature
through
that
Zoom.
is in the paid subscription that you
Okay.
can go in and activate.
That's great. We have a paid